Welcome to LaRainVial Asset Management's quarterly update on Latin American corporate credit. In this capsule, we share key trends and developments from this year's second quarter. This quarter, the markets recovered dramatically after a very tough first Q, with oil prices hovering around $100 per barrel in April and dropping to nearly $70 per barrel at the end of June. Global recession and inflationary fears started fading away. In the US, the one-year inflation swap dropped over 1 percentage point to 2.15%, as the market added 1 to 2 raises in the Fed fund rates expectations. This in turn echoed through the US Treasury curve, affecting especially the short end, where the 2-year bonds increased around 40 basis points, while longer maturities rose just around 5. The 10-year Treasury ended this quarter at 4.5%, up 20 basis points from the last quarter's closing. In this context, Latin American corporate spreads continue to decline. JP Morgan's CEMBI Broad Diversified Latin American Index compressed 60 basis points, mostly driven by its high-yield component, which tightened around 90 basis points in the quarter, while investment-grade spreads tightened 20 basis points. The region was best performer in terms of spread tightening during the quarter, among emerging markets once again. Looking at the JP Morgan Index at country level, Colombia was by far the top performer with close to 5% return in the quarter, driven by Abelardo de la Espriela's victory in the presidential elections. Argentina also delivered another good quarter with a 4% return, helped by S&P upgrade of the sovereign to B-. Even though Fujimori's victory was a positive catalyst for Peru by the end of the quarter, this country was the laggard in terms of return, basically due to tight valuations and higher correlation with the US Treasury being an investment-grade country. Mexico stood at the middle of the ranking, decently absorbing Moody's downgrade to BBB- during May. Summing up, JP Morgan CEMBI Broad Diversified Latin American Index returned 3.3% for the quarter, while our Latin American Corporate Debt SICA Fund returned 3%, recovering for the first quarter lost ground. Looking ahead within the region, we are closely looking at the Brazilian elections later this year, while globally, we are monitoring the durability of the peace process and its implication for oil and inflation. At our fund, we end the quarter with a yield to maturity of 7.6% and a 5.3-year duration in line with our benchmark. In terms of positioning, we are 83% high yield, 17% investment grade, overweight oil and gas, and underweight telecom, and at country level, overweight Colombia, Mexico, Brazil, and Argentina, and underweight Peru and the Caribbean countries. This has been a brief overview of Latin American corporate credit over the past quarter. For more information about this fund and all of LaRainVial Asset Management SICA strategies, please visit our website lvamfunds.com.